Now, we have impairment of financial assets. So now let's break this down first. If you look at this that we have, impairment of financial assets. Now, you already know that when we talk about financial assets, we are talking about three things. Abi, we are talking about cash, right? We're also talking about equity instrument of another entity. So that means probably we'll have an equity investment. Abi? And we're also talking about contractual cash or contractual right to receive cash, right? Which is debt investment. So this three we have is majorly a financial asset. Now, what we want to look at today is that the possibility that this financial asset can actually impair. One, if you look at cash, before I even look at this one, let's try and establish what do you mean by impairment. When we say an item has been impaired, really, you see, what impairment means is that the possibility that you might not recover the value of your assets, or the possibility that you will lose some of the value of that asset. That is, um, we are talking about where the carrying amount of an asset cannot be recovered fully. Where the carrying amount of an asset cannot be recovered fully. So that's impairment. So if you have an item that you are expecting 50,000 naira from, and if what you can only recover from it is 20,000, then we say that asset has been impaired, or that item has been impaired. That is, you cannot recover what you are expecting fully. So I'm just giving you a general explanation of impairment, though IS 36 said that when you have impairment is when your recoverable amount is higher than, or it is lower than the carrying amount of that asset. Then in that situation, the asset is said to be impaired. But I don't want to go to that route. What I just want you to know for impairment is that the carrying amount, you can no longer what? Recover it fully. So now if that's impairment, now let's speak cash, for example now. Is it possible that if you have money in your bank, is it possible that you might not be able to recover it fully? Is it possible? Cynthia, how is it possible? That one is part of the transaction. That one is just part of the transaction normally. Like you lost it for whatever reason or the other, beyond bank charging you for their services. No, that's not what we're talking about. Is it possible? It's not possible. So the only situation where you can have that is maybe there is war in the country. But even at that, your money will still remain, right? When the war finish, you go and collect your money. Another one that might result in that is that if the bank is distressed or the bank is liquidated, right? So though there's NDIC, but they won't give you your full money. They only give you a portion, right? Or maybe there's a military takeover. If there's a military takeover, military can say nobody should have access to their funds. They can block access. Yeah, they have that power. So, but generally, all things being equal, cash should not impair. Those examples I've given you are abnormal situations that we don't want to experience, right? So cash should not impair. So as far as this one is concerned, impairment, we won't consider cash. Again, equity investment. If you buy shares in a company, can you lose your money? How? It can go up again too now. Yeah, it fluctuates. So that's not impairment. That's just part of the characteristics of equity. It goes up and down. So that's not impairment. So again, for equity, impairment, no, it won't apply to that. Because the only situation where you will have suffered a permanent loss, because impairment is like permanent, you have lost it. So when you suffer the permanent loss, is a situation where the company goes under. That's when you have lost your shares. Other than that, you will still get back your money. Okay? So this not applicable, this not applicable. Right? Now, debt investment. If you lend somebody money, this one there's a possibility that the person can default for whatever reason or the other. He might not be able to pay. And this is what we want to look at today. So the first thing you need to know, as far as this portion of IFRS 9 on impairment of financial assets, this portion only relates to debt investment. It only relates to what? Debt investment. Because that is the area where you can suffer loss. Because you have lent somebody money, the guy can default. And that is that permanent loss we want to look at today. How do you account for that? That's what we want to look at. Furthermore, when you have a debt investment, it can be classified into three or measured in three ways. It's either you are measuring it at amortized cost, right? Where you are calculating your interest on the outstanding balance and all of that. Or you can classify it at fair value through OCI, or you can classify it at fair value through P&L. You see, this impairment of financial assets is only applicable to debt investment that are classified at amortized cost and at fair value through OCI. It's only applicable to these two. It is not applicable to debt investment classified at fair value through POL. Is not. Ordinarily, impairment should not even be applicable to all assets that are classified at fair value. It should not. Reason because fair value means you are looking at what's the value today. So fair value should have already taken into consideration if there is any impairment, whatever. It should have captured it. But you see, we have to consider this one because in determining fair value here, there's a portion you are taking to reserve. And reserve has the effect of you are carrying it over and over. So because of that, that's why you are having fair value through OCI being considered as part of the debt investment that can impair. Otherwise, generally, we don't impair assets that are measured at fair value because you will have considered it already. You will have known what's the fair value today. But because whenever there is changes here, you are taking it to reserve. So it's still there. It's still so impairments will affect this one. So by the time you impair this one, that is when you now have opportunity to write off that reserve so that it's off our books. Unlike P&L, fair value through P&L, whenever there is changes in fair value, that one goes for that year. It goes to P&L for that year. So whatever value you are having is the value as at that date, right? If you don't understand all I'm saying, what I need you to remember is that first, the financial asset we are considering here is only debt investment. That's one. Two, we're only considering debt investment that are classified at amortized cost and the ones that are classified at what? Fair value through OCI. Okay, beyond debt investment, there are other financial assets like trade receivables. Is a financial asset too. Can those ones impair? Yes, they can impair. In fact, popularly, we used to call them provision for doubtful debts, or sometimes we're calling them allowance for receivables. But now, it will be treated as impairment of that trade receivables, which you are going to learn very soon. Yes, trade receivables can impair. And there's another version of trade receivables, they call it contract assets, right? I will teach you that when I get to IFRS 15. But those ones too can actually impair. There are some other ones like lease receivable. I'll teach you that under IFRS 16, but those also can as well impair, which we call net investment in the lease. They can also impair, right? So, you need to remember these items because they can ask you in the exam that, yes, when we're talking about impairment of financial assets, specifically we are looking at debt investment. And the debt investments we are looking at are those that are classified and measured at amortized cost and at fair value through OCI, right? Then trade receivables and maybe contract asset and lease receivables are also part of the financial asset that can be impaired. Okay, so this is just an introduction now. Now let's go to the main work. Marker. Oh, all right. Okay, look up. Now, having understood what impairment means, having understood the financial assets we are considering here, then how do you determine or know that an asset has been impaired? Or at what point do you book impairment? So when you know, that's the first thing you need to establish. How do you do it? How do you know it has been impaired? So when you know it has been impaired, how do you keep it in your books? How do you reflect it in your financial statement? You see, historically, the way we do this before was that when you lend somebody money and the person defaults, meaning he's supposed to pay and he did not pay, we will be pursuing him until the guy, we know that he's bankrupt, that he cannot pay again, he's bankrupt. That is when we usually impair that financial asset. That is when we consider it as loss. So we will wait on the guy is distressed. But it created a lot of problem for us in the 2008-2009 era during the financial crisis we have all over the world. One of the reasons why we had that issue was because of the way we were booking financial assets. A lot of banks were having a lot of their receivables that they cannot collect again. But because of the accounting requirements in IFRS 9, they were still putting it there. You will see them having a financial asset of $9 billion, whereas what they can really collect is even less than $1 billion. So they have lost a lot of money, but accounting says that the guy must be bankrupt before you write it off. So they are still putting $9 billion there. So it was very, very misleading. People were thinking that these banks were okay. Whereas if they had done the right thing, no, they were doing the right thing. So because of that, they updated IFRS 9 that no, don't use this approach. Don't wait until this guy gets bankrupt. Until you are sure that this guy will not pay. Don't wait till then before you write off some of your collectibles or your receivables that you cannot collect. So that model then, they called it incurred loss model. That was the model we were using. But since that did not work, so they introduced a new model. They call that model expected credit loss model. And this is the ECL model. And this is the one that is applicable today. And this is one we want to learn today. You see, this ECL model, from the name, expected credit loss, meaning that don't wait until the guy defaults. Expect, anticipate that there will be a what? A credit loss. Anticipate it. Don't wait for it to happen. And that's the ECL model. So now, how does the ECL model works? The ECL model says that when you have a financial asset, specifically now either a debt investment or maybe a trade receivables or maybe a lease receivables or what have you, this standard says that these financial assets, you must classify or categorize them into stages. You must classify them or categorize them into stages. So now, let's look at those stages. Of course, there are three stages. There are three. I'll start from stage one. Stage one. Now, the standard says that immediately you originate a financial asset. So this stage is usually applicable on origination. What I mean by on origination, it means the date when you lend the person money or the date when you sold goods to somebody. That is the date of origination. So immediately you lend somebody money and you have a financial asset, that date you must classify that financial asset to what? To stage one. Immediately. Now, when you classify it to stage one, he said you should immediately book an impairment loss. So at this stage, the type of impairment loss you book, the standard call it a 12-month, a 12-month credit loss, or if I want to shorten it, a 12-month ECL. ECL as in expected credit loss. You book it immediately. Now, when we say book it, so the first thing we need to know is that yes, we are going to book an impairment loss, and the impairment loss is called a 12-month credit loss. And from this name, the meaning of this 12-month credit loss is that you are supposed to assume the possibility that there will be a credit loss within how many months? 12 months. So that means when you lend somebody money, let's say the person is supposed to pay back in the next 3 years or over 3 years. So on that date, when you lend the money, you need to sit down and look at, is there a possibility that this guy might not pay in the next 1 year? So that means you have to look at it. So what you are practically doing, you are just estimating. You are just estimating that, okay, is there a possibility that I will lose? So there are a lot of details in making that judgment or that estimation that the standard gave us so that people will not abuse it. So there are guides and there are models that they use to do it. But our own concern is the meaning. And the meaning is that the possibility that there will be a credit loss within 12 months, or the possibility that there will be a default event within what? Within 12 months. You see, in a simple way, in a very simple way, what this means is that we are saying it just this is just an estimate that you can estimate that, okay, this guy, I might probably lose 5% of this money within 1 year. So if the examiner wants you to calculate something, they will give you a rate that he made a 12-month ECL of 5% on origination, right? So if he makes 5%, what does this mean? It means that if the financial asset, is, let's say it's 100,000, that means we lent somebody 100,000. We are saying that on the date you gave that guy money, book an impairment loss, which we will call a 12-month ECL. This is an impairment loss. That means the impairment loss we will book is simply 5% times what? Which is how much? 5,000. So this 5,000 immediately, the first leg goes to your what? Your P&L. The second leg, you can put it in an accumulated impairment loss account. And that's what you do. So that means when you are preparing your statement, when you are preparing your statement of profit or loss, that means you have an impairment loss of how much? Of 5,000 naira. And in your statement of financial position, your financial asset is how much? 100,000. Then you deduct your what? Of how much? That means your net will be how much? 95,000. This is basically what we are saying that you're going to do. But, when you have debt investments, usually receive interest mostly. So this interest now, and remember that the interest that goes to P&L usually is the effective interest, because the effective interest will have considered the nominal interest. If there's any premium, it will have considered that. It will have considered all form of inflows that you're going to get from that debt investment. So if you have effective interest, effective interest is always calculated on the outstanding balance, right? For us to know what goes to P&L. Now, the question is this interest now, will it be calculated on the 100,000 or on the 95,000? The standard says that it should be calculated on the gross carrying amount, that is, on the 100,000. Why? You have not actually lost this. You have not lost it. You are just trying to be prudent by saying that there's a possibility that you might lose it. So your interest, you can still calculate it on the gross carrying amount when the financial asset is at stage 1. Okay, this is stage 1. Now, the next thing we'll look at is stage 2 and stage 3. There are 3 stages. All I've said so far is that when it comes to impairment of financial assets, which is the possibility that there will be a permanent loss in your debt investment, the standard brought in a model called ECL, Expected Credit Loss Model. And this ECL model, it says you should classify or categorize your financial asset into 3 stages. At stage 1, you classify all financial assets on origination, meaning immediately you lend somebody money, you classify them at stage 1. All of them at stage 1. And at that stage, you immediately book an impairment loss called what? 12-month credit loss. And that name describes how you get it. The way you get it is that you look at the possibility that there will be a default event within how many months? 12 months. That is what I mean by 12-month credit loss. And I gave you an example that, okay, let's estimate that our 12-month ECL is 5%, that we might lose 5%. So I did my 12-month ECL to be 5% of 100,000, which is the impairment loss. First leg go to P&L as an expense. The second leg go to accumulated impairment losses. So I showed you the statement here. And finally, is the interest you will receive on the financial asset. Since you have not actually lost this, the interest should be calculated on the gross carrying amount, not on the what? On the net. Now, so this is on origination. So at the end of the year, at each reporting date, the entity will be required to reassess the financial asset. So at the end of each reporting date, we need to reassess this financial asset. Now, what we are reassessing it for is this. We are reassessing it for changes in the economic environment or business environment of that borrower. So for example now, let's say you lend somebody money and the guy lost the contract. Maybe you gave him money for him to execute a contract. So the guy lost that contract. That means the guy might not be able to pay you. He has lost it. Or maybe the guy is in a country that, like what's happening to Nigeria today now, there was a devaluation of the naira. So, or there is huge increase in energy prices, or things are just very hard for him. So, see, those situations, what they indicate is that the guy might default. And when there is a possibility that somebody will default, we call that credit risk. We call that what? Credit risk. So the standard says that at the end of the year, you need to reassess that financial asset for significant increase in credit risk. If there is no significant increase in credit risk, if nothing is happening, things are going fine, that means that financial asset will continue to be at stage 1. It can be at stage 1 forever. If it's paying, when it settles, you take it off. And in fact, even at this stage one self, I estimated 5%. Some people might estimate 0% that there won't be loss. So you don't have to estimate. If you see that this guy is a good, no, you don't have to estimate. However, so if you are in an environment and you assess the financial assets and you discover that this guy is having a problem in his environment, is facing financial difficulty, the business environment is not favorable, that means there's an increase in significant credit risk, or there is a significant increase in credit risk. Immediately, you have to take the guy to stage what? To stage 2 immediately. And this stage 2 is where there is what? Significant increase in what? So you only take into stage 2 where there is significant increase in credit risk. And what this signifies is that, one, like for example now, where CBN released their financial statements, we saw that we have collected some money from JP Morgan, right? A JP Morgan, as of today, would have classified that financial asset to stage 2 because of the economic environment in Nigeria. There is devaluation of the naira, there is increase in energy prices, there is insecurity. That kind of environment makes business difficult. And a lender would categorize you into stage 2 and see that you might not pay. It's a possibility. So now, stage 2, there's significant increase in credit risk. Now, when you put it in stage 2, the type of impairment loss you book, the standard says you should book a lifetime credit loss or lifetime ECL. And from the name, what this one means is that to determine the amount of impairment you book, you have to consider the possibility that there will be a loss over the lifetime of that asset. So that means this one, you are taking it to a critical level. So now you are not considering a loss within 12 months, like in stage 1. Here, you are considering a possibility of default over the what? Lifetime. Lifetime ECL. What this simply means is that while you are doing 5% here, that means you might probably be doing like, let's say 25% here. You might be doing 25%. So when you are doing 25%, it means that your impairment loss will be how much now? At 25% will be how much now? It will now be 25,000. 25% on the 100,000. Abi? So that means how much will go to your POL? How much go to your POL? Sorry? How much? Yeah, that's correct. It's 20,000 that will go to your POL. Why? Because 5,000 is already there. You know that we were already accumulating 5,000 in the previous year. And this one will have been carried forward. So what we are doing in year 2, what we are doing is a reassessment. We are saying, no, it's not 5,000 anymore. It is now 25,000. So that's the reassessment. So what that simply means is that it is increasing from 5,000 to what? To 25,000. Is that increment we are considering? Therefore, what goes to P&L is that increment of 20,000. And the accumulated depreciation, 20,000 goes there also. That means it will have this, by the time you credit 20,000 to accumulated depreciation, it will then increase it to how much? 25,000. Okay. Now, that means in your statement of financial position and in your P&L is already clear that this is what will be there. But in your statement of financial position, how much will be there? In your SOFP, how much is the financial assets? 100,000. What's the impairment? So what do we have? Again, if this is what you present, then what will be your effective interest? Effective interest will be calculated, is we on 100,000 or 75? And the reason is that you have not actually lost the money, right? So just that you have increased the possibility of that loss because the guy is experiencing difficulty. It's not that he has stopped paying, but looking at his environment, there's a possibility that he might stop. So we don't want to wait until everything has scattered. We are saying, with this his environment, there's significant increase in credit risk. We increase the rates, but he's still servicing his interest as he should. So we'll still be calculating our interest on the gross carrying amount. Now, if the guy now finally defaults, meaning he did not pay for whatever reason or the other, he defaulted. So let me put stake 3 up here so I can have it all on the board. Now, the guy defaulted. Immediately, you categorize him to where? Stake 3. And this is where there is evidence of, of credit impairment. That is, failure to settle both interest and principal. The guy failed to settle. Immediately, you put him in stage 3. And in stage 3, the impairment loss you are still going to book is still called a lifetime credit loss or a lifetime ECL. This is still the impairment loss you are still going to book, but since the guy has failed, one will expect that you might probably increase how much you might probably lose to 75%. Okay, you are saying, okay, I would probably lose 75% of this total sum. And again, the effective interest now will now be calculated on the what? The effective interest will now be calculated on the net carrying amount. That is, if your financial asset, if it is 100,000 and the accumulated impairment loss is how much? That means whatever interest you have or you want to calculate will now be calculated on the what? On this net amount, which is this 25,000. And this is the entire story for the ECL model under IFRS 9. You will see that here, what you need to know is at what point, what does each stage, at what point, or what will warrant you to put a financial asset in each of these stages. We said for stage 1, that happens on origination. Immediately you originate the financial asset, you classify it as stage 1. But if there is significant increase in credit risk, the examiner might not tell you that there is significant increase in credit risk. They will just describe what is happening to the business, its environment, and all of that. You need to figure out that, this indicates a significant increase in credit risk, and you should know that that financial asset should be classified at stage 2. And in stage 1, what you are doing is a 12-month credit loss or 12-month ECL, and effective interest is usually calculated on gross carrying amount. But at stage 2, all you are doing is a lifetime ECL. That is a possibility that the guy will not pay over the lifetime. Again, this is forward looking. This is an estimate. It's just an estimate we are making. So that means we'll probably be increasing your impairment loss rate to an higher rate. And the effective interest is still calculated on the gross carrying amount. At stage 3, this is where the guy defaulted, where you have evidence of credit impairment. That the guy did not pay. So you still make a 12-month a lifetime credit loss, but the rate might probably be higher, right? And the effective interest will be calculated on what? On the net carrying amount. Okay, so that's the entire gist about the ECL model. Now let's look at well, it depends. So if you want to make it 100%, please go ahead. So again, it's just an estimate. You see, the guy might pay maybe after 2 years. He can default now, then later he now comes back and pay, right? So what we are saying is this: maybe the guy is supposed to be paying us interest every year. When it's time to pay interest, he defaulted. He did not pay. Then because the guy was okay, give me till next month. You will not pay. Then that one, we are not saying he might. So we are saying he has defaulted. He might still pay. So you could write it off if you want to, and you could just put it at 50% if you want to. It estimates, really. It really estimates. Just like the example I gave you about JP Morgan, we have a securitized loan with them of like $7.5 billion, right? So with what is happening in Nigeria, I would expect that financial assets in their book should be at stake too. So they say we are supposed to pay back in 2027. So if 2027 happens now, things are still going this way, we did not pay, they will put it in stake 3. We might still pay, not that we will not pay, but we defaulted. So immediately somebody defaults, it goes to which stage? Stage 3 immediately. But you see, magically, let's assume that JP Morgan put us in stage 2, right? And magically, all these companies that are leaving Nigeria, they came back. I read on the news that Nigeria, we are importing $5 billion worth of paper every year. What is happening? 5 billion worth of paper. Before now, paper, all these A4 papers that they used to do all of this, we import everything. Before now, we used to have paper mills here and there. We're manufacturing all of this in Nigeria. When I looked further, I saw that all the paper mills they have in Nigeria, all of them. In fact, the one that is close to us, there is one at Ijebu, Waterside. There is this paper mill there. Why? Because these guys have these trees. It's very easy for them to use it to make paper. You see, they left all their equipment. They went back to their country. They will now come to that village. They will cut the trees. They will take the tree to their country. They will use it to make paper. They will bring paper back to Nigeria. That is what is killing us in Nigeria. Dunlop has left. GSK has left. More will leave. Why? As it is now, we don't manufacture anything. And we say Naira is 700 Naira. Naira should be around, I'm recording, it should be worse than what it is now. I think they're still managing it, because if they allow the free market to flow, it's terrible. The only area where we are getting forex is just crude, and it's even terrible. We will export crude. We will bring out refined products. It's devastating. When you're doing research about all of these things, you can enter into depression. Why are we doing this? So let's assume that you guys became a billionaire magically. Cynthia now, she decided that what is happening in this country? She opened a paper mill somewhere in Aja inside, started. That means that $5 billion inflow is gone. We will not do that again. She She started to start manufacturing tires in Nigeria because we have all the raw materials we need to do it. Her, she started manufacturing all these shirts we are wearing, all this furniture, everything. So things are happening. Somebody opened a car factory. We're manufacturing cars in Nigeria. So what will happen to the naira is that one, it will strengthen, right? Because our demand for forex would fall. Government decided that a Dangote that was deceiving us, now his refinery started working. All our three refineries started working in Nigeria, so we don't import crude anymore. We don't import refined petrol. So everything was going fine. And you see, when all these things are happening, do you know what will happen to us? One, there will be employment, huge employment. There will be huge tax revenue. All these, all our bright people that are leaving the country, they'll start coming back because it's easier to stay in Nigeria than there. There is hell. You work like mad. Here, it's easy. Life is just easy here. People will start coming back. Our GDP right now is around $500 million or thereabouts, right? It goes to, let's say, $1 trillion. Things are going up. What will happen is that, you see, that money we are owing JP Morgan, would they still classify us as stage two? Where would they classify us? Stage one. Okay, so that goes to tell you that, you see, this classification we are talking about, it's extremely flexible. It's not fixated. So you might be at stage three today. Things can change for you. Maybe the guy started paying up. You don't have to put him in stage three. You just immediately reverse it to what? Stage one. You could be at stage two today, immediately reverses to. So this, we move in between these stages. Okay? But for your exams, it's nothing serious at all, which we are going to look at very soon. What I need you to know is your ability to explain 12-month credit loss and lifetime credit loss. You need to explain that. One, two, you need to know which stage, depending on what is happening, which stage should this guy be? That is, on origination, stage one, significant increase in credit risk, stage two, when there is credit impairment or the guy defaults, stage three. And majorly, that is really what we need to know. And finally, is how do you calculate that impairment loss? So let's look at those scenarios now. Stella. I don't understand. After stage one, from stage one, after 12 months. Yes, of course. So if the guy in the first year, at the end of the first year, let's say we lent him money for 3 years. At the end of the first year, he didn't pay. So he has defaulted. Okay? Immediately you put him in stage three. If he start paying back, okay, you can put him back in stage one. But if he's in a distressed environment, you put him in stage two because there is still significant increase in credit risk, right? Which one? Yeah. Okay, no, not really. That's not what we are saying. What we are saying is that when you have a debt investment, there's already a specified date when you're supposed to pay interest and when you're supposed to pay principal. So immediately you default on any of the dates, you take him to stage three. Immediately, it's not about 12 months, but the name they gave to the one on origination, the name is 12-month credit loss, meaning that when you are estimating the possibility of the loss, you are looking at, can he ask, can this guy have any problem within 12 months? Right? So that's what we are looking at. Let's go to page 44. Page 44, question 3. Page 44, question 3. Oh yeah, Elijah, read. Okay. Elijah is tired today. Yeah, Stella, read. Page 44, question 3. Yes, 3.0. Okay, so this question just want you to calculate the impairment loss. That's their focus, right? And if you look at this question, you see that this guy is in stage 2. He will have classified that financial asset as stage 2 because they already told us that the sector is operating is facing difficulty, and even already told us that there is significant increase in credit risk. All those are pointers that is in which stage? Stage 2. And again, the type of impairment loss they told us to calculate, they told us lifetime, Abi? So all those points already that in some questions, they will not tell you all those details. They will not tell you that there is increase in significant risk. They will not tell you that you should calculate lifetime ECL. They will just describe that situation to you, that this guy is experiencing difficulty. So they assume you should know that there is significant increase in credit risk. They assume you should know that it is a lifetime ECL that is calculated. But that's not the focus here. Now, here we want to majorly teach you how we calculate this impairment loss. So that's what this question wants to address. So now let's look at it. Again, if you look at this question, the interest, we gave this guy money. How much did we give him? We gave him how much? We gave him 50,000. And the effective interest per annum is how much? Meaning the contractual interest or cash flow per annum that we're supposed to get is 10% multiplied by what? So I'm expecting how much every year? But because of his difficulty now, what has happened? What has happened? Can I still get this 10% per annum? What will I be getting now? 6%. Is that what they told you in the question? 6% per annum. Okay, so they told us in the question that because of that difficulty, the guy cannot meet up with the 10% anymore. He can only do 6%, right? So the actual I will get now is 6% every year, which is how much? 3,000, Abi? So that means every year, how much am I losing? I'm losing 2,000 per annum for the next 2 years. In fact, this is what we call this credit loss. Now, you see, what we are trying to do is that the guy is assessing what can happen in the next 2 years. That this guy is supposed to be paying 10%, but he's now estimating that because of this difficulty this guy is experiencing, he might not be able to meet up with 10%. He might only be able to meet up with how much? 6%. So I don't need to wait until he start paying me 3,000. Or he start from this date, from the beginning, I will have estimated that I will be losing how much? 3,000. Sorry, I'll be losing 2,000 every year from the beginning. So now, if I'll be losing 2,000 every year for the next 2 years, meaning at the end of year one, I will lose 2,000. At the end of year two, I will lose another 2,000. So total is 4,000. If I want to record it in my books today, that is what you record in your books as an impairment loss today. So how much do you think I should record today in my books? If I will lose at the end of year one, 2,000, at the end of year two, another 2,000. If I want to record it today at the beginning of the year, or yeah, so how much will I record as a loss? You can't record 4,000. What do you say? Thank you very much. I've told you, whenever you have future amount, whether future inflow or future outflow, we don't record future value in our books. You have to discount it to what? Present value. So we will need to get present value of this amount. Again, if you want to get present value for annual payments, not just annual payments, equal annual payments, how do you do that? You do annuity. That formula 1 plus r raised to power minus 1 minus 1 plus r raised to power minus n over r, right? However, this one is just 2 years. I can do 1 year 2, right? So that annuity formula will have been sweet if I'm doing like 10 years. I'll just use, so let me just do this on year 1, year 2. But you can also use the annuity formula if you want to. So I want to calculate my impairment loss. Okay.
Yes, and then the 5%, 5,000, I don't know whether it comes from coupon
Okay. So you see, usually when you lend somebody money, there's usually an agreed rate called coupon rate or nominal rate. That's the interest, yeah, that should be coming to me. However, if you remember last week, we talked about effective interest rates, right? Effective interest is also coupon rates, but it includes some other things like premium. Let's say I lent you 10,000 naira, and at maturity, you are going to pay me back 11,000. I will still collect interest, though. So that means the interest I'm collecting nominal, but I'm collecting additional 1,000 naira, which we call premium. So effective will have considered those two. But in this case, effective and nominal are the same from this question, right? So that interest per annum, ordinarily it should be 5,000 per annum. But the guy is having difficulty in the environment he operates. So for that reason, we are estimating that he might not be able to do 10% per annum. Yes, it might be only 6% he can do. So that's why I compared my contractual cash flow, which is what is in the contract, 5,000, with my actual cash flow that I might get, which is 6%, which is 3,000. That means every year I will be losing 2,000. So I need to book it in my book today. That's the essence of ECL, expected credit loss. Book that loss in your books today, immediately. Don't wait until you lose it. But we are talking about future loss here. If you want to book future loss in your books, you have to discount it to present value. So that's why I want to do discounting now. So since this is 2 years annually, equal amount, I should just use annuity factor, multiply by 2,000 naira. I just want to do the alternative way to annuity factor. So if I want to do the alternative way to annuity factor, so in year one, what's my cash flow? Discounting factor at 10%. How much is that? What's the PV? Yes, now don't use the nominal, use the effective. Okay, they are the same thing here. So how much? 1818. In year two is still 2000. Discount factor in year two. How much is that? 1652. Let me add the two together. Sorry? If you can, the alternative way, you can use the annuity factor. 1 minus 1 plus r raised to power minus n. The n will be 2. The r will be 10% divided by r. Then you multiply it by 2000. It will give you the same thing. Okay? So, what the impairment loss you are recognizing is how much? 3,470. So, that means this amount will go to where? Your POL. You just call it a lifetime ECL. A lifetime what? Then the other leg go to where? The accumulated impairment, the accumulated impairment loss. Sorry?
Credit gain, I didn't have credit loss.
Yeah.
Is it possible to have credit gain?
Well, you can't have credit gain. Well, it's possible, but it's outside the scope here. It's possible. So that means probably be using like a fair value or something to get the value. Okay, so you don't understand why you're using present value. Again, you see, the guy is supposed to pay us 10%, but we can see that he's facing financial difficulty. Then we on our own, we estimated that we might only be able to collect 6% in the next 2 years.
Oh, so the value of what he's going to collect, we have to come to the
Present value. Cynthia, are you with us? Yeah, drop that phone. You have finished writing. You time double. Okay. Am I still blocking you? Ah, sorry. You won't go. Let me stand in front of Elijah. Better. That's my boy. Where's your glasses? Where it now? Follow me. What's happening today? You look dull and tired. Anytime your friend is not around like this, she's the last 2 weeks she was not around the same way. Be forcing her to be coming now so that you know that you need her. You need her. Elijah herself was even sleeping. What is wrong with you people? I get your point.